Hello friends, today we are going to discuss about risk regulations in the banking industry. We have seen that there are a lot of risk in the bank. The banking business cannot be done without taking risk. So it's all the more necessary that the whatever risk the banks is taking need to be managed. Then only the bank will be able to meet the objective. But now in this section we will see how the regulators comes into the picture as far as the risk management function of the bank is concerned. So the objective of the today's session will be to understand the global banking business regulation and how it impacts the banking business, and then we will also see how the Basel, the important the organization or the committee which was formed to globally regulate the banks in a way, has been over the period has evolved a mechanism to regulate the banks across the globe. In this process we will also see the role of the Basel Committee on Banking Supervision, which is known as BCBS. We will also see the Basel Accord of 1988, and then we will talk about the version 1.5 of Basel, and then Basel II, Basel 2.5, and we will conclude with the detailed discussion on Basel III Accord. Now, why banks need to be regulated? You know that in the banking business there are multiple stakeholders, and basically the banks accept deposits from the general public, whether it is developed country or developing country. Internationally, that has been the main source of resources for the banks, and these funds are deployed by the bank either by way of a loan or investment, and ultimately whatever they make out of this lending activity or investment activity is what ultimately comes to the kitty of the banks. So, and internationally, even the developed countries, we have seen that the banks play a very important role in the development of the economy. So credit growth in the economy has the banks have to play a very important role when credit extension is required, because all the businesses definitely cannot be started with their own equity. So to that extent, there is greater dependency of the banking credit to the development of the global economy. Here we will try to understand what is known as the safety net. The safety net is when the government comes to the rescue of any institution when it in the interest of the public. So banking institutions globally to drive the economy. So any failure in the banking industry, there is an impact on the economic growth. So ultimately, globally also there are instances wherein the government has stepped in and helped the banks to, if they are making huge losses. There are cases in the history where the government has stepped in and infused capital. When the government pumps in money into the banks, it has to be ultimately has to be borne by the one of the important stakeholders, that is the general public, who the government, when it funds the banking capital requirement through the budget, so ultimately the money has to be recovered by way of additional taxation. So, and then one of the important factor is banks are interdependent, because there are a lot of transactions which happen between banks, whether they are large, smaller, because all the banks cannot undertake all the activities. So mostly some of the banks which are very, very active in the international bank try to mobilize the resources from smaller banks and deploy them internationally, or only the money market placements, borrowing parts, the one bank borrows from other bank. So if there is a failure of a bank which has borrowed the money and is not able to pay on the due date, and ultimately if it is not able to pay, the bank which was supposed to receive the money will not be able to pay the money to the other bank from whom probably it has borrowed. So there is a contagion effect. So that's basically what is systemic risk. So one of the important need to the internationally why the regulators want to regulate the banks is to keep control over the systemic risk. And it was seen historically that the capital adequacy was not uniformly maintained, or it was not required to maintain across all the geographies. So there was some sort of a capital arbitrage when it came to the banking business. A lot of banks used to do activity considering the capital cost. So they used to generally undertake more of those activities for which the local regulators are prescribed less capital. So one of the reasons for the Basel, or the International Organization on Capital Adequacy, that is BCBS, was to bring in this kind of a level playing field as by prescribing not only capital adequacy, later on it added a lot of other monitoring tools. And again, there were not uniformity as regards the supervisory practices. The different regulators had different kind of practices. So the home country, host country regulations. So there was a need to at least to bring in some kind of an uniformity in the supervisory practices across the globe. Now this is symbolic picture of why we need to regulate banks. Basically one of the way the banks are regulated are by prescribing prudential norms, and it basically is to reduce the systemic risk. That's what I have seen, and again to avoid misuse of funds by the corporates or some of the people who are able to corner the banking funds. And important thing is banks deal with money, so the confidentiality becomes an important factor. And then credit allocation. Most of the countries, the government has some priority as far as the development is concerned. So they want that the credit has to go what they consider is most important, or what we call in India a priority sector. And there has to be a fair treatment of customers. So one of the regulations addresses this issue is to see that the banks behave or provide kind of a similar kind of service for as far as the pricing is concerned, rate of interest. So that's the kind of a fair treatment of customers is concerned. Now we have seen earlier what the systemic risk is. Systemic risk is basically a failure of the entire banking system. And if the bank fails, we have seen that the whole economy is dependent on the banking. So if there are bank failures, it also amounts to economic slowdown. And banks borrow them, between themselves, and banks are one of the bigger players in the entire financial system. And so if the banks, there is a failure, it has a contagion effect on the whole system. And that is where it's a very major challenge for the regulators. Now, how does regulation impacts banking? So basically the banking regulations addresses the safety and soundness of the banking system. One of the way it does is by prescribing capital requirements according to the risk profile of the bank, and creating a competitive playing field by setting common benchmarks for all the players. That's what we discussed earlier. Consequent to the regulations, what does it has done to the banks? So the regulation has resulted in a better definition of risk by the banks. So probably one of the important things which has happened after the regulation has taken phase internationally is better better risk management practices followed by the banks. And the regulator also gives some incentives when you manage your risk better. To that extent, the capital cost also goes down. Now let us quickly look at the impacts of banking regulations in India. If you have seen the Reserve Bank of India, the local regulator, has been quite active and has been very, very proactive whenever they have seen the signs of some negative impact on the banking sector. Whether it is a NPA management, we all know that the RBI came out in time with a lot of regulations, prudential norms. And internationally, though the capital requirement is 8%, RBI has prescribed 1% more. This is one of the, they call it a conservative approach, but it's from the prudential point of view, it's a good decision. And recently, RBI has come out on the corporate governance issues, as whether it is balance sheet, the disclosures are concerned, or about the way the accounting is done, and bringing in a lot of transparency. And it has also prescribed the better credit risk management by saying that if you are using the models to assess the risk, you should use them for internally, whether it is pricing, provisions, and all that. And KYC AML guidelines, you know that the RBI has been after all the banks, and there is a big improvement as far as the KYC AML are concerned. And RBI has also been instrumental in improving the information system in the bank. And automatic data flow project is one of the important platform through which RBI has started collecting the information from all the banks. One of the important organizations internationally which is very active in banking regulation is what is known as Basel Committee on Banking Supervision. Probably it has taken the settlement risk which happened with the Husted Bank, and it's based in Basel, and where the BIS, that is the Bank for International Settlement, is also located. And it gets the name from the place where this is headquartered. And initially all the G10 members were the members banks, and though it is G10, actually we have 13 countries who are members of this committee. And it provides a forum for regular cooperation on banking supervisory matters. So that is the importance of the BCBS. And it basically as the main objective is to improve the banking regulation worldwide, because most of the banks operate internationally. So because of the host country, home country regulation arbitrage issues, they want to basically have a uniform kind of a banking supervision worldwide. So they basically develop guidelines for supervisory standards in the area where they are considerable desirable, and the committee members come from 27 countries including India. But one thing is Basel Committee on Banking Supervision is not a formal supranational supervisory authority like your Reserve Bank of India for India. It is not like an organization which can stipulate the rules for other countries. So Basel Committee is best known for its international standards on capital adequacy, and the first major accord, Basel I accord, was for the convergence of capital measurement and capital standards. That is how we got what is known as a Cook ratio, which is basically a Basel I ratio, which talks about uniformly maintaining a 8% capital on your risk assets. So this is a brief history of the formation of the Basel Accord, which started with a uniform prescription of 8% capital on the risk-adjusted assets by the end of 1992. But the first accord was very crude in the sense it did not distinguish between different credit quality belonging to the same category. The groups, the categories which were considered, say, sovereigns, it did not distinguish between a country with a good external rating and the country which doesn't have a good rating. And the same was the case with the corporates. It did not make a distinction between a AAA corporate and a single A corporate. So the capital maintenance was uniform. So this is why it is called one size fits all. It was proved very disadvantage to the banks, and the focus was mainly on the main risk, because you know that in the banking the credit risk is one of the major risks, so it concentrated mainly on the credit risk. Operational risk, though historically the banks failures, most of the bank failures have been because of the operational risk, so there was not much of an attention for the operational risk, and actually there was no prescription of capital for the operational risk, which is one of the major risks faced by the banks. And the accord also did not address the complex instruments in the financial, whether it is derivatives or structured products. The Basel I did not address them. So there was a need for the new accord. So when we see the shortcomings of the Basel I accord, probably one of the major one was the one size fits all, that saying the same kind of risk assets irrespective of the kind of the rating of the borrower. So that is how it was felt necessary to have improvement in the existing accord, and that is how we saw Basel II. Before Basel II came in fact, there was Basel 1.5 version, which basically addresses the market risk, because you know that Basel I doesn't talk about the market risk, but Basel 1.5 in 1996 brought in the capital requirement for the market risk, because many of the banks started moving their assets from the banking book to the trading book, because there was no capital requirement for the trading book. So this basically is the movement from Basel I to Basel 1.5, which has talked about the capital requirement for the credit and market risk, and Basel II, which brought in what is known as the capital requirement for operational risk. And it also enhanced the credit risk measurement approach. And as far as the market risk is concerned, in the Basel II, there is no change from Basel 1 or 1.5. So this briefly tells what is Basel II. Basel II has, is an accord which consists of three important pillars. One is the minimum capital requirement, which is very similar to what was being there in the Basel I accord. And second important part is the supervisory review of the capital adequacy. This is one important factor of Basel II, which empowers the supervisors to prescribe a higher capital depending on the risk profile of the bank. And internally, the additional part is we know that pillar 1 risks are basically the credit, market and operational risks. But there are many other risks which the regulators have not prescribed capital for. Even in the credit itself, there could be some other risks, which like concentration risk, which the banks were not maintaining capital, and that is where under pillar 2, the banks are required to calculate additional, go through their entire business and identify those kind of risks which are not covered in the pillar 1. And wherever required, the regulator can always come and say you need to maintain additional capital. And the third one is the market discipline. It mainly talks about public disclosure about the kind of risk the bank is taking, the kind of capital the bank is having, the quality and quality of the capital, and so many details which are relevant or which can probably explain the risk profile of the bank.